Hello everyone and welcome. My name is Elliot Yu. I'm co-founder and chief analyst for Energy and Income Advisor. Last October, I released an open letter to all of the readers on our database saying that I felt that oil prices would reach $60 a barrel by 2018. And at that time, oil prices was actually under $50 a barrel, and a lot of people thought I was crazy. Oil was just coming off a major bottom in the summer. I also projected major gains for energy stocks and master limited partnerships, including a lot of high-yield master limited partnerships that really hadn't been performing well for the last couple of years in the energy bear market. Back in December, just about a month ago, I released a follow-up video, which you may have seen, where I projected that things were happening a lot faster than I had expected. And in fact, I expected acceleration to the upside for both energy stocks and MLPs here in 2018. Well, now here we are, right at the end of January 2018, as I'm recording this, and the S&P 500 Energy Index has had its best start to the year so far in 12 years, and the Alerian MLP Index, which is the key energy benchmark for master limited partnerships, this high-yield group of midstream energy companies, is seeing its second best start to the year in the history of the index, which stretches back to the early 1990s. Suffice it to say that energy stocks are moving very, very quickly. And I really think it's going to continue. And there have been some major changes which make me even more excited about what's going on right now in the energy markets. First of all, energy stocks and commodities tend to move in long-term cycles. And typically these cycles are anywhere from 8 to 10 years. I believe we're in the very early innings of a new energy upcycle. Think about it. Back in 1998, oil prices were trading in the low teens per barrel. And The Economist even ran a cover, the famous Economist magazine even ran an infamous cover saying that oil prices would get down as low as $5 a barrel. Of course, 1998 marked a bottom in oil prices, and over the next 10 years, up to the 2008 top, we actually saw oil prices go all the way up to $150 a barrel. Now, since that time, we've seen a little bit of a pullback in oil prices, of course, and energy stocks. And oil prices got back down to a low of $26 a barrel in the early part of 2016, in January and February of 2016. But here's the thing. Energy stocks still today, even though oil prices have more than doubled from those lows, trade at near a record low valuation relative to the rest of the S&P 500. I believe that we're beginning another one of those 10-year upcycles. So we had 10 years up from 1998 to 2008. We had another 8-year cycle down to the lows in 2016, and I believe that we are seeing the first start to another leg up in the group. One of the major changes that I think is just not getting enough attention in the media and in the financial press is that for the first time in 3 years, the cost of producing shale oil in the United States is actually rising, not falling. Those break-even costs since the top in 2014 have been coming down. And that's one of the reasons that the oil market has remained so oversupplied and energy stocks haven't been able to get out of their own way. But now we're actually seeing the break-even cost of shale oil production rising. And what that means is that we need higher oil prices to produce enough oil to meet growing global demand for oil, up about 1.5 million barrels a day worldwide in 2017, and I think going to be up similar amount here in 2018. Just let me give you a few statistics here. In Midland, Texas, which is in the heart of the Permian Basin of West Texas, the current unemployment rate is 2.6% compared to 4.1% for the U.S. as a whole, and over 6% as recently as early 2016 in that part of Texas. So there's a huge labor shortage. We're also hearing from a lot of the oil field services companies, including Halliburton, which reported just a few days ago, Schlumberger just a few days before that they are raising the costs of basic services like fracturing that they provide for the shale oil and gas industries. The costs are going up. At the same time, investors are demanding that shale oil companies return more capital to their shareholders. They generate actual free cash flow. But they're not constantly out there just borrowing more money to drill more wells without regard to the actual profit they make from those wells. And these companies are responding. We're seeing renewed capital discipline from the industry. And what that means is that companies are going to demand a higher return before they spend capital. This is a major upside catalyst for the group. That's why I think you're seeing energy prices so strong this year, why you're seeing energy stocks so strong this year, and I think we're in the very early innings of it. If history is any guide, however, you're going to see this happen very rapidly, and some of the biggest gains are going to come early in the cycle. That's one point. The second point is not all stocks will benefit. In fact, a lot of the stocks that did best in the last cycle aren't going to do well in this cycle. That's the history of the oil industry going back for decades. So I urge you to watch the short video which will follow these opening comments for some of the key points that I'm watching, for some of the key trends and investment and companies that I'm looking at to buy right now, before it's too late, before the best gains are already behind you. Thank you very much. Please watch this video through to the end.
Hi, my name is Elliot Gu. 5 years ago, I founded Energy and Income Advisor, an investment advisory newsletter focused on energy stocks and high-yield, tax-advantaged master limited partnerships, or MLPs. My firm has quickly grown to become one of the largest energy-focused investment publications, serving tens of thousands of investors around the world. Look, you may or may not have heard of me or my firm. A little over 3 years ago, I posted a video on the web, much like the presentation you're watching right now, in which I predicted that crude oil prices would ultimately fall to $30 a barrel or even lower. I also forecast devastating losses in many energy stocks, including oil and gas producers, deepwater drillers like Seadrill, proppant sand mining firms, and oil services stocks. Even as I presented my evidence and research, many pundits laughed at my predictions and told all who would listen to use the drop in energy stocks in late 2014 as a chance to buy the group at bargain basement prices. However, my fears about energy proved well-founded as oil prices collapsed into the 20s in early 2016, and some former high flyers I recommended selling 3 years ago, like Seadrill and Lin Energy, have declared bankruptcy, exposing their investors to devastating losses. However, I didn't create this presentation to boast or brag about a sell call I made 3 years ago. And I certainly have no desire to waste your time or scare you at this busy holiday season of the year. However, I believe what I'm about to tell you is so time sensitive, I couldn't wait until after the holiday season or until the new year to distribute this video to as many investors as I possibly can. I'm not exaggerating. I believe this video presentation and the trends I'm about to discuss could be even more important and more shocking than the energy sell call I made 3 years ago. You see, a little over 2 months ago, I hosted a series of online webcasts for a small group of VIP members to my research services. At the time, oil prices were trading around $50 a barrel, and I predicted crude would reach $60 a barrel by the summer of 2018. And I recommended a handful of energy stocks and master limited partnerships that I felt would benefit most from the move. Just as important, I warned that not all stocks would rally due to an ongoing changing of the guard in global energy markets. And I advised my listeners to sell some dangerous energy stocks and MLPs right away before it was too late. I created this video today because I was wrong, dead wrong, about the energy markets in my video presentation just 2 months ago. You see, while the trends I covered are already happening, the move is happening much, much faster than I had anticipated. West Texas Intermediate oil prices have already come within $1 a barrel of my $60 target and are likely to top that level by the end of January, 6 months before I'd expected. And due to a fundamental shift in the US and global stock markets that's already underway, a historic shift in fund flows that's set to accelerate at the end of the year and into 2018, the potential upside for many energy stocks and MLPs is much, much larger than I had expected. And it's going to happen a lot earlier in the new year than I had originally anticipated. And that's why it's so urgent that you keep watching this video through to the end before the trends I'm about to cover really take off. My research confirms the broader S&P 500 energy index could soar 40% to 50% by 2019, and the industry benchmark Alarian MLP index could see gains of 50 to 60% from current levels. Listen, I know these targets may sound aggressive, and you might be thinking I'm just exaggerating the upside potential. However, my research confirms these upside targets are actually on the conservative side. And I believe you can generate even bigger gains through careful stock selection and by avoiding some widely held, dangerous energy stocks that will struggle to benefit from the trends underway right now. Look, I don't expect you to just take my word for it or accept my predictions without facts or evidence. That's why today, as part of this video, I'm releasing a special presentation I gave to a small group of my VIP readers earlier this month. Keep watching this video through to the end and I'll explain why the energy fund knife fight underway since last month will help catalyze a major rally in the group starting early next year. Why only amateurs watch the price of oil while the pros monitor the shape of oil prices. The two major factors that will propel a breathtaking rally in energy stocks and MLPs to start the new year. How I derived my upside targets for MLPs and energy stocks, and why I actually believe they're conservative, not aggressive. Why we're entering the most profitable stage of the energy market cycle that I like to call the Goldilocks wave, and what it means for your portfolio right now. The $700 billion market tell that reveals the massive shift in institutional flows underway since August, and why it could turbocharge the upside potential for energy stocks and select MLPs at the beginning of 2018. And of course, 5 simple profit steps I'm recommending right now to take advantage of the big move higher for energy stocks and MLPs in 2018. Today, and only in this presentation, I'm going to do something I rarely have done in the past. Look, normally I wouldn't make a recording like this available free of charge. However, I believe this information is so important, and in fact so crucial to your financial well-being, that I can't just hide it behind a paywall. So I've decided to release it here today as part of this presentation and only through this website. I must warn you, my talk was unscripted, and I didn't want to waste time editing this video to make it pretty. I promise you I won't waste your time. Watch this short video presentation, examine all my facts, evidence, and charts, and then decide for yourself if I'm for real. Conference in Houston, Texas, where I presented to a small group of mainly people involved in the energy industry. I predicted, and that was when oil prices were still up around $80 to $100 a barrel. I predicted that oil would ultimately reach lows under $30 a barrel. This was actually the chart I put up in the first slide in that presentation back then. It's the underlying rationale I had for predicting the big sell-off in oil prices over the last few years, and it's actually the main rationale I have for predicting a rally in oil prices, and particularly in energy stocks over the coming year or two. So this is the basic cycle that underlies all commodity markets. I'm going to go through it quickly because I have a lot of slides to get through today. Let's start with, at the top of the cycle, oil prices are very high. Now there's three main factors that are interrelated in a commodity cycle. There's supply, demand, and price, and they're all related, and let me explain how. At the top of this cycle, oil prices are relatively high. It's right at the top at 12 o'clock if this were a clock, for example. Oil prices are very high. When oil prices are high, that has an effect on demand and on supply. When oil prices are high, it tends to reduce demand, which we call demand destruction, because people use less oil when it's $100 a barrel than they do when it's at $50 or $40 a barrel. On the supply side, high prices encourage new supply growth, right? Because exploration production companies are willing to go out and spend more money developing new oil fields when the price of oil is at $100 a barrel compared to, say, $25, $26 a barrel, where it went at the beginning of 2016, at the beginning of last year. Now, as oil prices start to come down, because they begin to come down at this point because you have weak demand and strong supply, and that's the basic factor that weighs on oil prices. As prices begin to fall, eventually you get down towards that orange segment of the chart here, the orange segment of the cycle chart, and there you have the opposite effect on supply and demand. Low oil prices encourage demand, strong demand growth. For example, over the last couple of years, we've seen some of the strongest global demand growth for oil of the past 20 years in terms of barrels a day, both in the developed world and in the emerging markets. On the flip side of the equation, low prices also discourage supply growth. So when the price of oil is low, it's less profitable for exploration production companies to produce more oil. Therefore, supply begins to moderate or outright contract. Now, we've certainly seen that outside the United States this cycle. There's not been a whole lot of spending. Spending's really fallen off a cliff since the 2014 highs on things like deep water exploration and development. Here in the United States, though, the development of shale fields has meant that a lot of shale producers, because of new technology, are able to make money at much lower oil prices, and therefore their supply has held up better than a lot of people expected 3 years ago. That said, we're already seeing pushback against the big shale producers. Investors are demanding not just that they grow their oil production, but also that they make some money, that they generate free cash flow at these lower $50 to $60 a barrel oil prices. And therefore, we're even seeing these moderate to low prices discourage stronger shale supply growth. And that's one of the reasons why I think oil prices are bottoming out. To summarize, 3 years ago, when I threw this chart up on a slide in a presentation I gave to a group in Houston, I thought we were here, where I just put that red circle on your screen. High oil prices causing demand destruction, encouraging very rapid supply growth, particularly in shale. That was 3 years ago. Today, I believe we're here, where I just put this green circle on your chart. Prices have bottomed out. We probably won't see oil approach anywhere near where it got back in early 2016. In fact, I don't think we're going to see sustained prices below $50 a barrel in 2018 for West Texas Intermediate. And they're beginning to rise, actually. Oil prices have come off their lows. As a result, though, what we're seeing around the world is very, very strong demand growth, as I mentioned, which obviously is bullish for oil prices. And we're seeing some moderation of global supply growth. I just gave the caveat about shale being able to make money at lower oil prices. However, given the increases in costs that we're seeing in the shale industry, in some cases talking about 10-15% annualized cost inflation in the shale industry in places like the Permian Basin, I think that U.S. shale producers really need $55 a barrel oil to $60 a barrel oil on average to see growth in their output. And I think that's what we're going to get. We're going to get slower than expected growth in U.S. shale oil supply output. And that's going to allow prices to remain at a comfortable level in that $55 to $60 a barrel area. That is what I like to call the Goldilocks wave. Because oil prices aren't so high that they discourage demand and lead to rapid growth in supply, but they're not so low that they hurt the entire industry. That's where we are. Traditionally, this is the most profitable phase of the cycle for energy. Now, a lot of people think right now that oil prices are relatively low, and the reason that they think oil prices are relatively low is that they are in comparison to the extraordinarily high oil prices we saw back in 2013, 2014. But this is a long-term chart of inflation-adjusted oil prices going all the way back to 1861. These are annual average prices from 1861 to 2016. For this entire period, the average inflation-adjusted price of oil, and this is Brent oil, was about $35 a barrel. If we look at just the period since 1970, which is when OPEC really began to manipulate higher the price of oil, the average price is around $55 a barrel. Now, in 2016, which is the last data point on this chart, the average price of Brent crude oil in 2016, that's last year, was about $43 a barrel. So that was below the post-1970 average. Right now, though, the price of oil, Brent oil, is up closer to $60 a barrel, a little over $60 a barrel right now. So that's actually a little bit above the average price of oil since 1970. So don't get stuck in that recency bias of thinking that oil prices are very, very low right now and that $55 to $65 oil is unattractive. It's actually way above the average that energy companies have enjoyed since the early 1970s. And we think it's, again, a very comfortable level for a lot of energy companies. How do I know that this rally in oil, unlike all the other rallies over the last 3 years since 2014, is for real and not just another false dawn? This is an indicator that's not new for me. This is something I have put up a lot over the last 3 years. And here's the key point. Amateurs talk about the price of oil. Professionals talk about the shape of oil prices. What do I mean by shape? Well, these are the futures curves for Brent very recently on the 6th of December of this year, which is the orange line, and a year ago on the 6th of December 2016. On the 6th of December 2016, i.e. a year ago, the Brent oil market was what we call in contango. That means that the near month price of oil was around $54 a barrel. And the further you went in the future, you can go in the futures market and contract for oil for delivery 6 months from now, 12 months from now, 5 years from now. As you went further in the future, the futures price of oil was higher. So as you can see, the curve kind of slopes upward from lower left to upper right on my chart. This is very bearish. Just remember this as a rule of thumb. I'll explain a bit more in a minute. This is very bearish for oil prices. The main reason is because it suggests a market where there's an encouragement to store oil. In other words, if I can buy oil at $54 today, store it for 6 months, and sell it in the futures market for $58 a barrel, I have an incentive to store oil. The current price of oil is very low relative to the price of oil in future. This is typical for a bear market in crude oil. Now look at that orange line on the chart. This is a chart of Brent oil futures roughly today. And this is a chart showing a market in what we call backwardation. That means that the futures market curve slopes from the upper left to the lower right, downward sloping. This is bullish. This typically indicates a market which is very tight on a supply-demand basis and which global oil inventories are falling. That's because storage absolutely has no value. In fact, it has a negative value. If the price of oil today is, as on this chart, around $60, $61, $50, $62 a barrel, and the price of oil for delivery in early 2020, say, is down around $57 a barrel, I actually lose money by storing oil today and selling it at lower forward prices. This market is telling when the futures curve looks like this, a backwardated market, it's telling energy producers, it's telling energy to produce more oil now. Not to wait, not to store oil, to produce more oil now because the market's short of oil. There's not enough oil out there. This is a very bullish environment for oil prices. This is another look at backwardation in the Brent oil futures market. This is simply the price of oil for future delivery 12 months from now versus the price of oil for delivery in January in this case. And what you can see, so it's the difference between the price of oil for delivery 12 months from now and 1 month from now. When this number is positive, it's a market in contango. When it's negative, it's a market in backwardation. And what you can see here is that the market was in backwardation up through the middle of 2014. At the middle of 2014, it was around $5 in backwardation. By middle of 2014 rather, by early 2015, it was about $10, $11 in contango. Today, we're actually at about nearly a $4 backwardation again. This is the largest level of backwardation we've seen since the middle of 2014. What you'll note is between the second half of 2014 and the last 3 or 4 months, the Brent oil market has consistently stayed in contango. This ratio has been above $0 a barrel. Therefore, every single rally we've seen in oil has been accompanied by a market remaining in that contango upward sloping shape, again, which I've told you is bearish. Only on this most recent rally have we seen the market flip to backwardation, telling me that the rally is for real. Not only are oil prices going up, but it's supported by a tightening supply-demand fundamental. This is just one of the indicators I look at, but it's extremely powerful, and I'd encourage you to use it yourself. At the same time, even with this backdrop of energy market prices improving, commodity prices improving, energy stocks are near record cheap. This is a chart showing the weight of energy stocks in the S&P 500 in the entire index. So in other words, when today energy stocks make up about 5.9% of the S&P 500, back at the highs in 2008, in the middle of 2008, energy stocks made up more than 16% of the S&P 500. There have only been 3 occasions in history where energy's weight in the S&P has dropped below 6%. That occurred in 1998, 1999, again in 2002, 2003, and over the last few months. On each of these occasions, we saw a big rally in energy prices subsequent to getting down to that level of valuation. It's a measure of valuation because it tells you what market sentiment is towards the industry. These lines I've drawn on the chart, that middle line, that gold line, is the average since 1990, energy's average rate in the S&P 500, which is about 9.3%. The red line is 1.5 standard deviations above the average. When energy's gotten overvalued on that basis, it's been a good selling opportunity historically. And that green line is 1.5 standard deviations below the average. It's a little under 6% of the S&P 500 where we are today. That's historically been a very good buying opportunity. My target for many energy stocks to be up 40 to 50% by 2019 is partly based on this chart. I'm not even thinking energy is going to get back up to an average weight in the S&P 500. But let's say it gets up to a weight of about 8.3%, which is a full percentage point below the long-term average weight of energy in the S&P 500. If that happens, the sector goes up 50% over the next couple of years. So I don't think that's aggressive at all. I think an aggressive target would be to say that it gets back to an average valuation where you're looking at roughly a 60-65% gain for the S&P 500 energy index itself. And I think the gain could be a lot bigger for certain subsectors and individual stocks within this group. Master limited partnerships, a high income tax advantage group. Most of them are based in the midstream energy business. So they own things like pipelines, like natural gas processing plants, like oil storage terminals. This sector is also near 30-year lows in valuation. And one way I like to value MLPs is to look at the yield on your average MLP in the industry benchmark Alerian MLP index and compare it to a 10-year US government bond. As you can see, the average valuation since 2006 for MLPs is about a 4% premium. In other words, MLPs tend to yield about 4% more than 10-year US government bonds. Right now, we're at a 6% premium. The average MLP in the US yields over 8% compared to obviously the US Treasury, the 10-year US Treasury bond down in the low 2% range. So MLPs, the only time they've been cheaper than they are today is at the very beginning of 2016 when oil prices were plummeting under $30 a barrel, and the height of the financial crisis in late 2008 and early 2009. As I showed you, when oil prices were also plummeting back then, what I showed you though was that oil prices right now today, even if we don't get any more upside next year, are actually trading at a pretty big premium to the average price of oil, inflation adjusted, since 1970. There's no way that Alerian MLP index should be trading at the kind of valuations it's only historically seen with prices way below the average. We think we're going to see a big snapback. If the MLP index gets back to just that average yield premium to the 10-year, you're looking at about a 50% gain over the next year, 12 to 24 months. Incidentally, every time the Alerian MLP index has experienced a down year since the year 1999, it's experienced a big snapback rally in the year following that down year. Looks like the Alerian's going to close down for 2017. The average gain in the subsequent year is about 35%. We see a lot of upside for master limited partnerships. One more thing to keep in mind. The current economic expansion started back in 2009, June 2009. The current market rally started back in March 2009. This rally is very old by historic terms. Only one rally in history is older than the current market rally, the current bull market. Historically, energy tends to perform well late in an economic and market cycle, in the last year or two of a market and economic cycle. What I did here is I looked at the last year of both of the last two bull markets and the first 6 months of the subsequent bear market, and you can see that energy handily outperformed the S&P 500 over this time frame. In 1999 to 2000, so the end of the late 90s bull market, the beginning of that 2000 bear market, 2000 to 2002 bear market, energy up almost 30% compared to a 4.8% gain in the S&P 500. In the more recent bull market that ended in 2007, the first 6 months of the 2008-2009 bear market, energy up 47.98%, almost 50%, relative to just a 3.6% gain in the S&P 500. I think if I'm right, and we're in the latter stages of this economic cycle, energy is going to be one of the brightest spots you'll find in the S&P 500. So what's going on in the energy market today? And why are a lot of energy stocks still not responding? They've rallied off their August lows, but they're still not responding as they normally would to the big rally in oil prices we've seen since mid-year and really over the last couple of months. There are a couple of factors going on right now, and they're mainly factors that we believe and have traditionally faded out as we enter a new year. The first is what we call the energy fund knife fight. And this is actually a phrase that I've heard a couple of different places talked about. And what it is that imagine if you had a dedicated energy mutual fund or a dedicated energy hedge fund or a dedicated energy ETF over the last 3 years, with oil prices collapsing from over $100 a barrel to less than $30 a barrel at the beginning of 2016, and then seeing a rally to $55 a barrel at the beginning of this year, followed by a sell-off to 42, all this volatility. Energy stocks have been the worst performing sector in the S&P 500 so far this year. If you're a dedicated energy-focused mutual fund, you're probably getting a lot of redemptions from your investors. Those investors are looking to lock in tax losses on their energy investments before the end of the year, so they can take the tax loss here in 2017. And they're also looking at the other parts of the market, and historically, investors chase performance. And it's usually the worst thing you can do, buying a sector or an index when it's near an all-time high and selling it when it's sort of near an all-time valuation low, but that's what people do. And that's never changed through history. I don't really see it changing anytime soon. These energy-focused funds have seen near record levels of redemptions. This is a quote from an investor letter I saw from Barron Energy and Resources Fund, which is a dedicated energy-focused fund. And you can read the whole quote as well, but just look at the two phrases I've underlined here in red. This redemption of shares equated to more than 25% of the fund's net assets. So in the summer, this summer, with energy stocks underperforming the S&P so much, investors in this particular fund redeemed 25% of the outstanding assets of this fund. So what does a mutual fund or a hedge fund have to do when its investors redeem assets? Well, they have to raise that cash somehow to fund those redemptions. So, you own a mutual fund, you have $100,000 in there, and you say, I want to sell that mutual fund and get my 100 grand. That mutual fund company is going to go out in the market. They're going to have to go out in the market, sell off their part of their portfolio to raise the cash to pay you back. And that's exactly what's been going on. And in this case, Barron Energy and Resources Fund said they had to harvest losses to build up the fund's capital loss carryforwards. This is the future tax liability. And they did that to fund all those redemptions, equating to 25% of the fund's net assets. Of all the sectors in the S&P 500, as I mentioned, energy is the worst performing in 2017. So it's the sector that's seen the most tax loss selling. Now again, this is a situation where if you're an investor and you owned a broad portfolio of stocks in 2017, you're up on average around 20% in the S&P, your IT, your technology holdings up 38%, healthcare holdings over 20%, consumer discretionary up 20%, financials up 20%. You've got big gains in all those sectors. But you probably have losses in your energy holdings because the energy index was down almost 8% on a year-to-date basis through the 14th of December. So what are you going to do? You're probably going to sell off some of your energy holdings so you can realize those losses in 2017 and write them off against your taxes. And that's exactly what's been going on. We've seen a lot of tax loss selling in the energy market to end 2017. Now the good news is that most investors who wanted to redeem money from those energy-focused funds have already done so. So that selling should abate as we enter 2018. And tax loss selling, obviously, will begin to abate as we enter 2018, as we end this year, because if you're going to realize your losses for tax purposes, you have to do it before December 31st. So we think that's artificially been keeping energy stocks are generally starting to rally, but those two factors have been keeping a lid on those energy price rallies, and they're about to change, and it's all going to happen as we enter 2018. We think the rally could be earlier in the year than we thought, and it could be truly breathtaking in some of these very cheap stocks. When you have energy fund flows turning around, tax loss selling turning around, and a sector that's near record cheap. You have a recipe for a lot of upside. And here's one more factor to consider. This is a market I like to look at pretty closely because I think it tells you a lot about what sentiment's like in the overall industry, in the overall stock market. And this chart shows the total assets under management in a group of ETFs, exchange traded funds, known as smart beta exchange traded funds. You may not be familiar with the term smart beta, but basically what it means is that these are ETFs that track various fundamental characteristics we call factors. For example, some smart beta ETFs focus on growth companies, companies that generate a lot of earnings growth, like Amazons of the world. Others focus on value stocks, stocks that screen well on price to earnings, price to book, price to sales. Others focus on high quality stocks, stocks that have steady profitability throughout the economic cycle. And these different smart beta ETFs or smart beta ETFs track different fundamental characteristics. And this market has exploded. Back in the first quarter of 2011, total assets under management in the smart beta ETF industry in the US alone were only about $135 billion. Today, as of mid-December 2017, it's up about over $709 billion market. So this is a huge and growing market and a huge and growing part of the ETF market. It's up 427% since the first quarter of 2011 alone. That's over the last 7 years. So I like to look at not only the growth in the total amount of assets in these smart beta ETFs, but where is the money flowing? That can tell you a lot about what stocks are going to win and what stocks are not going to win in the coming year. Now here is a look at two of the biggest categories of smart beta ETFs out there, just the fund flows since the early 2015. And that is value ETF, smart beta ETFs and growth focused smart beta ETFs. And I'll tell you the number one characteristic that you can look at that governs where money flows is what's going on with economic growth. When economic growth is accelerating here in the US, investors are going to tend to favor value companies. That's because most value sectors are more cyclical. They're more exposed to the economic cycle. So value outperforms when economic growth is accelerating. When economic growth is decelerating or is weak, growth outperforms value. That's because stocks like Amazon.com, Netflix of the world, they're growing their earnings based on secular growth factors, changes in consumer behavior, for example. They can grow regardless of whether the US economy grows at 1.5%, 2%, or 5% annualized. And so what we saw is that in the very end of 2016, going back around the time of the presidential election, we saw a big surge in flows into value sectors, which is the blue bars on this chart, in November and December and January. So November and December of last year and January of this year, of 2017. And that was based on the idea that that incoming Trump administration was going to enact tax cuts and other reforms to goose up US economic growth. When it took a lot longer than some people expected for tax reform to come about and for the GOP in Congress and President Trump to push major legislation through, there became sort of a disillusionment that economic growth might not pick up. And therefore we saw in March, April, May, all the way up through the middle of summer, all the way up through July, we saw more money flowing into growth sectors, growth ETFs rather than value ETFs. And that's why technology performed so much better than anything else up until about August of this year. Since August, though, you'll note that value has really taken over the driver's seat from growth. And we've seen, in fact, the largest inflows into value funds this December since late last year and early this year. So value is definitely getting more attention now. Growth is beginning to lose out over value at this time. Now, why is that important? That's important because not only is it ETFs, but it's also mutual funds and hedge funds. It's many trillions of dollars if you include all of those. And that's money that's shifting into value stocks, of which energy is one of the largest components of most value indices, and out of growth stocks, of which the largest component is really tech. I believe that's going to also just add fuel to the fire and accelerate the rally in energy as we enter the first half of 2018. It's all happening a lot faster than I expected, and I think it's something you want to. So there you have it. Energy stocks and MLPs are trading at close to 30-year valuation lows, despite the big rally in oil prices since last June. While energy stocks have beaten the S&P 500 since August, year-end tax loss selling, the knife fight underway between energy funds, and energy fund redemptions have acted like a brake on the rally so far in November and December. And here's what's really important. I showed you that a massive shift is underway in favor of value stocks, and energy stocks carry a hefty weight in value indexes. We believe the rally could be breathtaking once tax loss selling abates, and the big institutional rotation in the energy value stories begins early in the new year. Listen, I promised you I'd reveal 5 simple profit steps we're recommending to take advantage of the big rally in energy stocks that's just getting started. So let me start with this. Profit step number 1, our shale checklist. You want to buy the 5-star producers. Upstream energy firms, also known as exploration and production or E&P companies, are in the business of leasing acreage, drilling wells, and producing oil, natural gas, and other energy commodities like propane, ethane, and butane. As I explained a little earlier on in this letter, U.S. unconventional shale fields have been the most disruptive change in global energy markets since the development of advanced offshore drilling technologies in the 70s and 80s. Production growth from key U.S. shale fields, such as the Permian Basin of West Texas and the Marcellus Shale gas field in Appalachia, have become the swing factor in global energy supply and have shifted the U.S. from a culture of resource scarcity a decade ago to one of resource abundance today. However, I must warn you, making serious cash in the upstream is not as simple as buying a collection of E&Ps when the price of oil rises. Just consider there are a total of 65 companies in the widely watched S&P Oil and Gas Industry Index, and over the past 2 years, the best performing 10 stocks in the index have soared 62.6%, while the 10 worst performers are down 47.9%. So you might be wondering, how do you distinguish between the industry haves and the have-nots? Well, to make these decisions and sift through our universe of over 100 upstream energy companies we follow, we've developed a simple 5-point checklist we use to evaluate all exploration and production companies. Here are the criteria in brief we look at. Debt. Nothing gets an oil producer in trouble faster than having too much debt. So we look for producers with low debt or at least a credible plan to reduce debt over time. Capital spending and production growth. We look for companies that can generate strong oil production growth while spending within their cash flows, even with oil prices around $45 to $50 a barrel. Valuation. The animal spirits of greed and fear run rampant in the E&P space as investors get excited about certain prospects and lose interest on other oil plays. Dividends and buybacks. One of the E&Ps we favor recently announced a $2.5 billion stock buyback that we believe could help drive the stock sharply higher over the next 1 to 2 months. Another offers a dividend yield around 5%. Management. This is the toughest to quantify, but when you've been analyzing energy companies as long as I have been, you start to learn which management teams have a history of delivering on their growth targets and which are just full of hot air and empty promises. Look, I don't have time in this short video to give you all the details of the E&P stocks that score best on our 5-factor checklist, but we've assembled all you need to know about our top 10 E&P recommendations, including buy targets on these recommendations, all as part of a brand new report on the industry. I'll show you how to get a copy today with absolutely no risk or obligation here in just a second. However, first I want to tell you about this, profit step number 2. Big yields, big growth. Australia, Canada, and Mexico. The U.S. imports more oil from Canada than from Saudi Arabia, Kuwait, Nigeria, Iraq, and the rest of OPEC combined. Yet, despite the nation's long-standing importance as an energy producer and exporter, the past few years have been a massive stress test for Canadian energy firms. You see, the rise of low-cost oil supplies from shale fields like the Permian and Bakken has tempered import demand from the U.S., which is traditionally Canada's biggest market. I know that may sound like bad news, but consider this. Canadian energy firms have literally been forced to adapt or die. The result? Massive industry consolidation that's resulted in a handful of high-quality firms that control the very best reserves, pipeline capacity, and assets. Here are just a few of the stocks my colleague Roger Conrad and I have uncovered. This under-the-radar Canadian operator has small-diameter gathering pipelines and gas processing facilities connected to some of Canada's most promising and lowest-cost fields. It pays a dividend of 4.4%, that's growing at a 5% plus annualized pace. Or how about a pipeline operator that's in the middle of an acquisition that will give it an enviable footprint in the Montney Shale? Perhaps the largest and cheapest to produce gas and natural gas liquids play in Canada. Plus, the company has a 7% plus yield that's grown at a near 9% annualized pace over the past 3 years, despite a tough market for oil and gas. Our 5 Canadian survivors, the producers that have done the most to drive down production costs in the face of low oil and gas prices, and will see the most upside now that energy is on the rise again. Plus, there's a kicker. Dividend yields on these stocks as high as 6.1%. And have you heard about the Australian energy crisis? Australian natural gas prices are absolutely soaring, up by a whopping 165.8% this year alone compared to the 2015 average. The problem isn't a lack of gas reserves, and it's not unusual weather or storm damage to production facilities that's driving up the price of gas down under. The problem is this: liquefied natural gas exports. As Australia ramps up LNG export terminals, exports of the fuel to gas-hungry customers in Asia and further afield have reduced supplies for the domestic market, raising the ire of consumers facing higher gas and electricity bills. However, there's one Australian energy firm that had the foresight to see this problem years ago, and it built up significant coal-fired and renewable energy electricity generation capacity to take advantage of those sky-high power prices today. This company is at the forefront of new technology, including one of the world's first massive utility-scale power storage projects that will allow it to integrate more intermittent wind and solar power to Australia's electricity grid. And unlike most alternative energy plays, this forward-thinking energy firm has real cash flows, real earnings, and a very real yield of 5.3%. I'd like to give you immediate access to our latest report on international energy stocks to buy right now, including details on exactly how and at what price to buy these names starting today. I'll show you how to reserve your risk-free copy in just a moment as part of a no-obligation trial to Energy and Income Advisor. However, first, I promise to show you this. Profit step number 3, changing of the guard, stocks to avoid. I can't stress this enough. If you want to generate real wealth over time from the energy sector, knowing which stocks to avoid and which dangerous stocks to sell is every bit as important as knowing what names to buy. This is always true, but it's most crucial in the early stages of a new energy upcycle. Just remember, a little earlier on in this presentation, I explained that bear markets in any sector of the market tend to bring about changes in leadership. Many of the energy stocks that led the great energy upcycle between 2001 and 2008 were laggards in the 2009 to 2014 upcycle. Listen, as I record this presentation, I'm looking at our coverage universe table of the 86 MLPs we rate in Energy and Income Advisor. Right now, we rate 34 of those MLPs as sell. That's nearly 40% of all the MLPs we cover, about the highest proportion of sell-rated MLPs we've ever had in our coverage universe. And here's what's even worse. Several of the most dangerous sell-rated MLPs we follow also happen to be the large cap names that are widely owned by many individual investors and are prominent components of many of the popular MLP exchange-traded funds out there. In fact, 4 of the most prominent names we've been rating sell for some time have already slashed their distributions this year, and there's much more pain to come. That's not what I desire for you. It's absolutely crucial you examine your portfolio carefully and cut out any dangerous energy stocks you may hold. Simply put, these names are ticking time bombs that could devastate your portfolio with little warning. To help you get started, I've assembled an investment blacklist of widely held energy stocks and MLPs that you should sell right away. Again, I'd like to send you this special blacklist report right away so that you can act today before it's too late. I'll tell you how to get immediate access to our blacklist, also completely risk-free, in just a moment. However, before I do that, let me tell you about this. Profit step number 4, under the radar energy buys. To my knowledge, no other energy-focused research publication in the world does this. Think about it. From the moment you wake up to brew your morning coffee or tea, to the moment you fall asleep at night to a good book, virtually everything you do involves energy and energy commodities in one form or another. The truth is that there's just no industry that's more vital or indispensable to the global economy, our health and well-being than energy. Let me give you an example. As I mentioned earlier on in this letter, we warned our readers that oil prices were headed to $30 a barrel back in 2014 when crude was trading closer to $100 a barrel. So what do you do when oil prices are about to tumble? Just sell out of all your energy stocks and run for the proverbial hills? Absolutely not. You see, there are plenty of industries and companies that can actually benefit from falling oil prices, falling natural gas prices, and falling electricity rates. For example, we recommended American Airlines back in January 2014, about 6 months before the bear market in oil even started, on the view that weaker oil prices would result in a dramatic fall in fuel costs for the airlines, which would generate windfall profits for the group. The result, we recommended selling the stock in November 2015 for a profit of 59.7%. Or how about cruise operator Royal Caribbean, which benefits due to the fact that falling gasoline prices frees up consumers' cash for discretionary purchases like cruises. The stock soared 21.1% in less than 1 year from our recommendation in December 2014 through our sale in November 2015. Bottom line, it pays to look beyond the traditional oil and gas sectors for other companies in other sectors that can see big benefits from changes in energy prices and in the energy sector. To be clear, we do not recommend buying these plays, American Airlines and Royal Caribbean, on falling oil prices now that oil prices are back over $50 a barrel, and we think likely to average $55 to $60 a barrel in 2018. However, we still see energy-related secular growth opportunities outside the traditional oil and gas sectors. For example, consider this. Low interest rates and a supportive regulatory environment have catalyzed increased capital spending by U.S. utilities in response to growing demand for gas-fired power and renewable energy, both which offer superior economics to older plants that burn coal. In fact, our work suggests more than $100 billion per year in capital spending by U.S. utilities for 2017, 2018, and 2019. One of our latest recommendations, a small engineering and construction firm based in Houston, Texas, wins a shocking 65% of the North American utility transmission and distribution contracts greater than $100 million. This firm appears ideally positioned to profit from this multi-year spending cycle in the utility sector. And with an even bigger share of the Canadian market, the company stands to benefit disproportionately from Alberta's push to phase out coal-fired generation. We see upside of 30 to 50% in this under-the-radar construction name over the next 2 years. And what about saving energy and cutting costs? That's absolutely crucial, particularly at times like right now when oil prices have stopped falling and are likely to see some upside over the next few years. Well, how about something I heard about at an energy conference in Fort Worth earlier this year, in a conversation with one of the world's largest oil services companies. The company has tens of thousands of pieces of equipment in the field, including pumping equipment used to prepare shale oils for production, trucks, earth-moving equipment, and workover rigs used to repair older wells. So as you might imagine, this giant firm spends some serious cash staying on top of the maintenance of all this equipment. Everything from changing belts and oil filters to complete engine rebuilds. After all, if a crucial piece of equipment fails and delays a major drilling project, the time lost can be very expensive. Some oilfield services companies have actually missed quarterly earnings expectations in the past due to higher than expected maintenance costs and longer than expected equipment downtime. Historically, equipment maintenance was scheduled. Just as you might change the oil in your car every 6 months or 4,000 miles, oil services companies scheduled maintenance for key equipment based on its time in the field. However, that's not ideal because equipment just doesn't always fail on schedule. the company still saw costly equipment failures and downtime on a scheduled maintenance program. Instead, this company has installed sensors on its equipment that measure factors like running temperatures, vibrations, engine performance, and noise. These sensors then automatically transmit data that's analyzed on an ongoing basis. The result, the company's data analysis software knows when equipment needs maintenance, when something is about to fail or needs replacing, and it automatically schedules that equipment for repairs. It's called predictive maintenance, and it's already saving this firm millions of dollars each year and boosting their equipment uptime, efficiency, and reliability. Listen, I know this sounds like science fiction, but I assure you it's not. It's an example of one crucial technology that's already been widely deployed or is in the later stages of development. In fact, it's nothing really new. You see, dramatic cost reductions for certain crucial components and services have made this technology, previously available only in a limited number of high-value applications, they've made it downright ubiquitous. This advancement is already revolutionizing industries as varied as construction, air travel, technology, insurance, energy, even agriculture, entertainment, and manufacturing. In fact, 2 years ago, consulting giant McKinsey & Company shocked many observers when they estimated this industry would produce $11.1 trillion each year in economic value. It's called the Internet of Things. And while it's not directly related to producing more oil or gas, I guarantee you energy savings from the Internet of Things will revolutionize the way consumers, businesses, and factories use energy in coming years. Of course, making all this work requires a veritable explosion in data collection, storage, transmission, and analysis as multiple industries embrace the efficiencies and opportunities created by the Internet of Things. These trends have driven a powerful upgrade cycle in semiconductor equipment to meet demand for three-dimensional memory and the migration of microchips from 32 layers to 64 and beyond. Fabricators must retool and expand to take advantage of these opportunities. Over the next few years, these trends will generate serious growth for one small Colorado-based technology company we follow that sells advanced power management products to the semiconductor manufacturing industry. What's even better is that unlike most stocks leveraged in the Internet of Things these days, this company is still cheap, trading at a big discount to the broader market on a price-to-earnings basis. We believe this overlooked technology firm that sits at the heart of the Internet of Things megatrend could see gains of 50 to 70% over the next 12 to 24 months, and the stock is already on the move. To help you get started, we've created a new report that covers some of these under-the-radar energy buys, and in just a moment, I'll explain how to reserve a copy of this 18-page PDF report in your name as part of a special 60-day risk-free trial subscription to Energy and Income Advisor. But first, I just want to cover one more profit step we're recommending right now in this letter. Profit step number 5, high yields and low taxes, the top 5 MLPs to buy right now. MLPs are an extremely profitable and tax-advantaged market niche. However, I must warn you, there are also some very serious dangers in this market that are widely overlooked by many investors and most of the so-called experts. You see, we believe the changing of the guard theme we outlined earlier presents some particularly grave dangers in the MLP market. Let me explain. Before shale became such an important factor in the global energy market, the U.S. pipeline system was set up to handle growing imports of oil into the U.S. Pipelines are set up to transport crude oil, for example, from coastal ports to refineries around the nation. Today, U.S. reliance on imported oil is falling, and production from fields in West Texas, Oklahoma, and North Dakota, among others, is growing at a breakneck pace. So many of the pipelines that made economic sense in 2007 are completely unnecessary in 2017. And new pipelines, gathering systems, and other basic infrastructure needs to be built out to serve these fast-growing shale basins. Simply put, many of the largest and oldest MLPs, the names that are prominent holdings in many exchange-traded funds and individual investor portfolios, built up pipeline, processing, and storage assets before the shale boom. In some cases, they failed to adapt to changes in U.S. energy supply, production, trade, and pricing wrought by the shale boom over the past few years. Just consider, Plains All American was long considered an MLP industry bellwether and rewarded unit holders with a 340.2% return during the last bull market from March 2009 to June 2014, a gain of 32.6% annualized. Just 2 years ago, 23 of the 26 Wall Street analysts covering the stock rated Plains a buy, and absolutely none of them recommended selling the MLP. Many investors were undoubtedly attracted to the company's growing 7% yield at that time. However, Plains All American's stability was a mirage 2 years ago. You see, as production volumes across many of the MLP's pipeline and gathering systems began to decline, Plains started to rely on its own marketing division, a business set up to trade regional pricing differentials in commodity prices to keep its pipelines full. As regional pricing differentials began to collapse, profits from the marketing division shrank, and Plains could no longer cover its payout. The result, last year, Plains slashed its quarterly payout from 70 cents to 55 cents, and this past summer, management has announced a further cut to just 30 cents a quarter. As a result, shares in Plains have collapsed as much as 35.9% this year alone. The good news is that while many of these old guard MLPs are in trouble, there are a number of other MLPs, many of them smaller and overlooked by most investors, that are actually well placed to benefit from growth in U.S. shale production without the dead weight of legacy assets rendered obsolete by the shale boom. That list includes a high-quality Ohio-based MLP with the industry's largest slate of assets in the fast-growing and low-cost Marcellus shale field of Appalachia, including 5.6 billion cubic feet of gas gathering capacity and 8 billion cubic feet of gas processing capacity. In addition, the company is making a fundamental change to its business structure that we believe will dramatically lower its cost of capital, raise its distribution growth prospects, and act as an upside catalyst for the stock this year and next. The stock yields 6.5%, is growing its distribution at a nearly 8% annualized pace, and the stock is up more than 12% over the past year alone, despite a very tough market for energy-related shares. Listen, I don't have time in this letter to tell you all about all of our top MLPs to buy right now. However, I've assembled all the details you need to know about our top 5 MLPs to buy now in a special premium report posted on our website. I'd like to send you a copy of that report today before these high-yield MLPs really take off. Listen, I don't take these forecasts and recommendations lightly, and I'm not just another cheerleader permanently bullish on energy stocks. Just remember, I was among the first analysts to warn investors about the collapse in oil prices to under $30 a barrel back in 2014, and I was among the first to recommend selling high-profile energy stocks like Seadrill, High Crush Partners, Halliburton, and National Oilwell Varco. And I've consistently advised investors not to buy into the false dawn rallies in oil over the past 3 years. And I warned that OPEC's production cut deal in late 2016 would actually result in huge downside for oil. However, today I'm absolutely convinced this is the best buying opportunity we've seen in the energy sector in nearly 20 years. And the gains in select energy stocks and MLPs will be breathtaking. In short, I don't want you to miss out on this opportunity. And to help you profit from what I believe could be a dramatic rally, I'm going to do something I've never done before. Please just give the work I've done a look, and I believe you will have all the information you need at your disposal. The best part is you can take a look at my research and receive everything I've mentioned here for 2 full months, that's 60 days, with absolutely no risk or obligation. Simply click the Start Your Risk-Free Trial button below and let me know you'd like to take a trial subscription to Energy and Income Advisor today, and I'll rush you a username and password for our secure website, granting you immediate access to all of the special reports, recommendations, and research outlined in this presentation. And what if I told you that you could ask me and Roger Conrad any question you like about oil and natural gas prices, specific energy stocks and MLPs, or even the broader stock market and economy? Ask us any question you like and have those questions answered immediately. That's exactly what we do each month in our online chats with subscribers. Roger and I remain online for as long as it takes to make sure your questions are answered. To my knowledge, we're the only research firm that offers this level of service, and our monthly chats have quickly grown to become, by far, the most popular feature of our service. We have another monthly online chat coming up in just a few weeks, and I'd like to make sure that your name is on the list of attendees so you can have all your questions answered. Normally, risk-free trial members of our Energy and Income Advisor service have 30 days to try our service. Cancel your membership in the first 30 days, and we offer a 100% money-back guarantee. However, we're so convinced it's the best buying opportunity in the energy patch in years, we've decided to extend our trial subscription offer to a full 60 days. Click the Start Your Risk-Free Trial button below and sign up for an Energy and Income Advisor at our discounted charter rates. Download all the reports and research I've covered in this letter. Check out our model portfolios and attend our monthly online chats to have your questions answered, and only then decide. If you don't feel Energy and Income Advisor is worth every dime of the subscription price, cancel in the first 60 days. Keep any research reports you've downloaded with my compliments, and I'll immediately issue you a full refund with no questions asked and no hard feelings. I guarantee it. Please click the Start Your Risk-Free Trial button below this video to get started today.